Hello and welcome to a brand new episode of Smart Money. Now, the big investment call this year was on auto stocks. Stocks like M&M and Eicher Motors have risen 30 to 50% in 2022. In fact, in the last fortnight, two big fund houses, ICICI Pru and IDFC, came out with thematic mutual funds on the transportation and logistics sector. So today we speak to ICICI Pru about their new NFO. Our expert is Harish Bihani, Senior Fund Manager at ICICI Pru AMC. He's right here with me. Harish, thanks so much for joining us. But I think, the bigger question really is about the transportation and logistics sector itself, right? Just wanted to start by asking you about that. There's been massive growth potential talked about in this sector. What all does this entail?
Sure. Thanks, Sonia. When you think about this particular sector, you have to think about the auto OEM stocks, whether it's Maruti, Mahindra, Tatas of the world. You'll have TVS Motors and Bajaj Autos of the world. Then you have to think about the auto ancillary names, again, phenomenal companies here. You have Uno Minda, Sundaram Fasteners, Schaefflers of the world. And then you have logistic player, whether it's the Container Corporation, which is the largest rail operator, the road operators like a VR Logistics, even new age companies like a e-commerce delivery, or for that matter, Zomato is also included as a part of this particular theme.
So you're focusing on the whole auto and logistics space, right? Transportation is your bigger theme.
Absolutely. So we'll cover the entire gamut of auto ancillary, logistics, and anything which is related to this particular theme.
Okay, this is a very exciting space to be in, right? So let's take it one by one. The opportunity in the auto OEM space, let's talk about that. Because there is the wide umbrella is auto OEMs, but there's so much that comes below it. And many of these stocks have rallied already. I was talking about how M&M is up 50% this year.
Sure.
So where do you see the opportunity, both in terms of value and growth?
Sure. So you will have to think about this entire uptick that we have seen. You have to look at in the context of what can happen over the next 3 to 5 years. This entire spurt, this came in because things have started reviving in terms of volumes. The commodity prices have started cooling off in this particular sector, and people have started realizing that there is value in this particular sector, right? Now, we'll have to think about the context where we are in at this point in time. When you think about the last 10 years, for the passenger vehicle segment as well as the two-wheeler segment, they have been negligible to even marginal volume growth. And why has that happened? That has happened, let's look at the last 6 years, for example. Last 6 years, we had 6 major disruptions in India, or 5 major disruptions. We started with GST implementation, then it was followed by IL&FS crisis, then we had demonetization, it was followed by the COVID-19 crisis and the Russia-Ukraine crisis. So these were the macro changes which happened in our country, and fundamental changes or the global changes which led to impact on income of people. Then you had changes which happened because of regulatory reasons, which were micro reasons for this particular sector. You had the change from BS4 to BS6. You had insurance cost changes. You had axle load norm changes for commercial vehicle industry. You have safety norm changes for, again, the entire industry. So what happened is that in this industry, you had either a big macro hit because income got hit in certain parts, or you had a micro hit because regulatory norm changes, and then you had this entire cost increase which took place. Now we are at a point in time where things have started stabilizing. The incomes of people which got hit during COVID has started kind of gradually improving or inching up, right? Which means volume will come back gradually for this particular segment. Secondly, in terms of the overall value growth which is coming in this particular segment, that should also kind of start reflecting in numbers. Third is commodity prices have started coming off, right? So it's a combination of volume play, value play, because there's premiumization opportunity. We can speak more about that subsequently. And there's this margin improvement play, which is why we are looking at this theme very closely.
So there are a lot of, like we can see on the screen as well, right? There's passenger vehicles, there's utility vehicles, multi-purpose vehicles, there are light commercial vehicles, heavy, and the two-wheeler space. Now, these are very, very different brackets, right? Two-wheelers, for example, are still struggling in the export market. Domestic market has not recovered to its full capacity. So particularly for that space, I mean, what kind of opportunities do you see? And after very long bear market, how are you so confident that there will be growth returning in the two-wheeler space?
Absolutely. So we'll again have to think about the context, as we already kind of discussed, that there were issues in terms of an income hit, which had an impact on the demand. Now let's divide India into 3 buckets. You look at the top 25 to 30% of India today, they have better income versus pre-COVID. They're all doing well, right? They're purchasing more, they're doing more discretionary purchase. Look at the next 40%, beyond that 30%. The middle 40% is what is struggling or was struggling till about a year back. their income is still below pre-COVID, but things are gradually reviving for this particular 40%. It's still not back to pre-COVID numbers, right? Which is where you saw that hit to the entry-level cars. You saw that hit to that entry-level two-wheelers. And this is the particular segment which is kind of slowly and steadily improving as we speak, right? So we'll have to think about where is the demand coming from at this point in time. Demand is coming from more premium cars, more premium two-wheelers. You're seeing more electric vehicles consumption at this point in time. The bottom part is where there's a hit, which is going to revive over the next couple of years. And this is going to be a gradual process. So we aren't kind of at this point in time making a hypothesis that this is going to be a very fast recovery. This is going to be a gradual recovery over the next couple of years. But thankfully, it seems to us, but from a demand side as well as from the cost side, things have hit a bottom and things can only gradually improve from here on.
Okay, there was a very interesting graph actually. I just want my director to pull it up once again. The number of cars per 1,000 people in India,
Correct.
right, compared to what we see across the world.
Correct.
So there are just 24 cars in India per 1,000 people compared to say US having 340 cars and Italy at 650. Now this is not apples to apples comparison because
Correct.
the per capita GDP is very different for developed countries, and for our own country, you know, we have issues like infrastructure issues, road problems, etc. So I just want to talk about, is that a very simplistic argument that we are on a structural uptrend only because the penetration is so low? And what kind of sustainable growth do you see?
Sure. Sonia, you'll have to think about, you know, there's a lot of noise in the equity markets, there's a lot of global volatility, and we all get bogged down by near-term stuff. But think about India. India is a $3.5 trillion ballpark, $3.5 trillion economy. We'll move to a $10 trillion economy in the next 12 to 15 years, right? We can debate it'll happen in 12 years, you will tell me 15 years, somebody will tell me a different time frame. So if that happens, the per capita income on average for a large part of the population will start inching up to closer to 2,000 and higher. It's already happened in certain parts of India, in certain states like Maharashtra, Gujarat, Karnataka, where you're seeing that the overall consumption is far higher. Once it happens across India, that is where you will start seeing this entire penetration which you spoke about in terms of the per person overall consumption at this point in time is far, far lower, both in terms of two-wheeler as well as passenger vehicle. This will start kind of inching up. So this is a big opportunity. We as a country are going to move up to a much higher number. Per capita income will move up. And finally, with that should start reflecting in volume, whether it's the entry-level car or whether it's some of the premium cars.
Okay, and we all know the listed players, right? Here, there's M&M, there's Maruti, there is Tata Motors, of course. But auto ancillaries, I want to talk about that. It's a very wide scope over there.
Right.
Because there are maybe 100 auto ancillaries in a car, right? Auto parts, rather.
Right.
Tell us, where all do the opportunities lie?
It's there all across. Our companies, when you look at our entrepreneurs, and the kind of work that they are doing at this point in time, phenomenal work our entrepreneurs are doing. Just to kind of, you showed this particular graph over here. Say, for example, the alloy wheels, which is a part where 100% was imported till a couple of years back. Today, 70% is done in India, and next 2 years, 100% will be done in India. So this is an import substitution play, right? And this is being done by our entrepreneurs who are identifying areas which can be done in India at the lowest cost. You have opportunities in new areas like ADAS, sensors, BMS. So there's a whole host of opportunity which is coming up in the entire auto ancillary space.
So you want to talk about the companies, of course, these are not, of course, buy recommendations, but
right.
Which are the companies that are doing parking sensors, door switch panels, alloy wheels that you spoke about, the leading players there? Sure.
So I'll give you a couple of examples, and without naming companies, but to give you a rough idea of how things are shaping up. You think about one of the largest fasteners company in India, right? Now there's this PLI incentive that has come up. With that, they are doing a 350 crore capex for the export market. So they are not only gaining with higher proportion of overall volumes coming from the domestic market, and they're getting into newer product lines. Then they are also trying to do capex with all these incentives for the export market. Similarly, when you think about one of the largest bearing companies in India, it has identified a couple of key components. Again, with this PLI incentive, it makes sense to manufacture in India, not only for the Indian market, but for the export market. You have one of the largest, well-diversified auto ancillary player.
So like Minda Industries, for example.
For example, Minda Industries.
Every part of the car, I think there's like 80% of the car that Minda supplies to.
And you look at how they have kind of overall look at their journey over the last 5 to 10 years.
The value
They've
chain.
identified the components, which component should work in India? What is the volume at this point in time? How will this shape over the next couple of years? Can we indigenize? Can we make this in India? And finally, the right kind of partnership. So this is a very structural trend, which is not only going to help the auto ancillary companies capture the domestic market in a much higher way, and there are good companies doing that, but significant part of the export market, because this entire China plus one and Europe plus one theme is for real. This is going to take time. People talk about near-term numbers and say there's going to be volatility and things won't play out. But this is a far more structural trend which will play out over the next couple of years.
Also electric vehicles, right? I mean, FADA put out the data this week where they spoke about a 200% rise overall in industry and over 150% in passenger vehicles, etc. We've seen a new launch from Hero in the electric vehicle space. So within that bracket, which are the companies in the auto ancillary space that could dominate?
So again, you look at auto ancillary, we'll divide it between two-wheeler companies and the four-wheeler companies. You look at two-wheelers, there are about 18 to 20 companies, new companies which are trying to penetrate this particular market. Nonetheless, you look at the incumbents, they are all working hard to ensure that they're on the right side of disruption. They're trying to get the products which should ensure that they gain market share incrementally. Similarly, you look at the four-wheeler players. Most four-wheeler players have got credible products or are in the process of getting those credible products in the market. So at this point in time, what we think is the listed incumbent players have a decent chance to ensure that they kind of retain the market share or in some cases gain. That said, there are certain companies that we have identified which are not on the right side of disruption, haven't invested so much.
Which ones?
Unfortunately, we can't name that, but it will get reflected in our portfolio soon. So which is where this entire active management will come into play. We'll try and kind of have significant underweights and name which we think are not on the right side of disruption, will lose out, and vice versa. We'll have very high weights and names which we think are on the right side of disruption, will gain more market share, have the right model cycle, or are the right auto ancillary company which are gaining share, as one of the companies you mentioned.
Okay, well, let's do one thing. There's also the logistics sector, which is huge in its own way. So we'll slip into a short break. Don't go anywhere. When we come back, more on smart money. We'll talk about the logistics sector and how you can invest there. Stay tuned. Welcome back to Smart Money on CNBC TV 18. We're talking about the big opportunity in the auto, transportation and logistics sector. Before the break, we were speaking to Harish Bihani of ICICI Pru about the big trends in the auto sector. And now let's talk about logistics, because a lot is being done by the government as well to push this sector. So tell us, what are the key trends here?
I think we'll have to kind of think about the big picture first over here in terms of what the government is trying to do. Government is trying to formalize our economy with the implementation of GST and all the other changes that the government have done over the past many years now. And in that context, government came up with this policies on Gati Shakti or the national logistic policy. Government is trying to do is to ensure that the efficiency of the entire system improves. And with that, the logistic companies or the logistic players or the overall logistic cost in our country at this point in time is in double digit as a percentage of GDP. This is leading to market share losses, especially global market share losses. So government is aiming that we should get this down to single digit, closer to developed countries over the next 5 to 10 years. If that happens, what happens is that we'll start gaining market share from global players. Our working capital level comes down. We become significantly efficient as a country, as some of the companies start gaining global market share. And this is the theme which is there. And in that context, as the overall country formalizes, the companies formalizes, there is a market share gain in terms of unorganized to organized. And that is another theme which is playing out in many sectors as we speak. It's already played out because of COVID. It's got even faster. And that is a theme which is going to play out significantly over the next couple of years.
So you want to compare the Indian markets with other developed markets. I'm just trying to understand what is the kind of potential that you see here in India versus other developed economies.
If you look at, say, the other developed economies, logistic play a fairly critical role, whether it's the port players, the rail network, the road network, etc. And these are in terms of the absolute sizes, these are far bigger in terms of the absolute size, right? And why does that happen? That happens because you look at these formal companies, some of these organized companies, they keep gaining market share from the unorganized players. So that is what has happened in developed markets, which is going to play out in the domestic market too over a period in time. Because the efficiency which a formal organized company will be able to get to over a period in time is going to be significant. So this is a trend which has played out in most developed markets. Big have become bigger in logistics space, and that is going to happen in India too.
So, there are a lot of players here, right? You spoke about delivery a while back. There's TCI Express, and several of them have been gaining quite a bit of market share as well.
Correct.
Tell us that, what are the top companies here that you would look at? I mean, these are, of course, not recommendations, but where do you see the shift from the unorganized to organized? Who do you think could be the big beneficiaries of this?
All across. You look at whether some of the largest port companies, think about what the size 5 years back versus today, and think about where some of those will be. Similarly, you look at some road logistic players, there was a lot of hurdles because unorganized used to be a significant part, and there used to be a lot of tax leakages in the system, which is getting plugged as we speak, and that is going to even get plugged over a period in time. So some larger companies will keep gaining share. Similarly, you have the rail operators. Again, there are credible companies in this particular space. So in each and every space, you have credible companies that have been gaining gradual market share, and this trend should likely continue. Again, as we spoke in terms of the auto plays, there are companies which are investing, whether it's in people, process, technology, etc. We have to identify those companies which are reinvesting what they are gaining at this point in time to ensure that they are on the right side of disruption. They will gain market share over the next 3, 5, 10 years to come.
Okay, so you have a fund, right? An NFO. There's the ICICI Prudential Transportation and Logistics Fund. You spoke about what your entire investment rationale is, but tell us a little bit more about this fund. What are the kind of stocks? If I'm an investor in this fund, what are the kind of stocks I would get exposure to? You
will get exposure to the entire gamut of auto OEMs, the best in the class, with right model cycle, right market share gain opportunity, right volume value growth opportunity. Value will come from premiumization, right? You will get opportunity in terms of margin expansion because commodity prices are coming off, and most of these OEMs have passed on all the cost hikes to the consumers. And this is going to be a gradual play. Similarly, you will get the best of the auto ancillary companies. These are great entrepreneurs who have reinvested money to ensure that they get those higher component value, as you spoke about in one of the examples. And again, in logistics, you will get the companies which are formal already, but these are organized companies which will keep gaining market share, and this is fairly big opportunity over the next 10 to 15 years.
Okay, but the problem with thematic funds is that, I mean, they of course are back in vogue now because the market is sort of picking up. But generally for a long-term investor, thematic funds tends to get a bit tricky because you don't know when that theme is going to its life cycle is going to play out. What would your argument be to that?
No, absolutely. So one has to think about the context of where we are in the business cycle, where we are in the growth cycle and the margin cycle. So when you think about these three characteristics, and then you think about the overall kind of changes that could happen, you would see that we are at closer to the bottom of the business cycle, the growth cycle and the margin cycle. So one should be worried when you are at the top of these particular cycles. We think that we are not there at this point in time. Or you would get worried if our country is not growing, the income levels are not growing, and there's a large section of the society that will continue to struggle beyond, say, the near term that we are already seeing at this point in time. But if you think that our country will get far more affluent and there will be a section which will continue to buy more discretionary goods, then this is a theme which should play out on average in the long term, right? So that is what our call is.
That's the rationale. Okay, well, Harish, it was a pleasure speaking with you. Thank you so much for joining us on Smart Money, and all the best for your fund. Okay, that's the big space that we're looking at, right? The transportation, the logistics theme, and what to expect over there. But time now for the financial tip of the week. This is our weekly column where we tell you how to be financially savvy. And today we're going to talk about 3 important details every public provident fund account holder should know. Now, on the taxation front, we know that if you are a PPF account holder, then there's the magic of exempt, exempt, exempt. However, since the last year, there is a new rule in effect. It's an unknown fact that there will now be a TDS payment on partial withdrawal in excess of 20 lakhs if the person has not filed the income tax returns in the last 3 years. So your tax is not completely exempt. If If you don't file income tax in the last 3 years, then you would have to pay partial TDS on your PPF amount. So that's something that you need to keep on your radar. The second is on the maturity date of the PPF, the Public Provident Fund. We all know that the Public Provident Fund maturity date is 15 years, but here's a fact that not too many people know. The maturity date is not calculated from the date of opening the account. The 15 years is calculated from the end of the financial year in which the first deposit was made. And finally, a PPF account for minors. If you want to open a PPF account for minors, you can, but it can be opened by either parent. So one account per child. You cannot have 2 accounts on 2 different names, and grandparents cannot open a PPF account for a minor. So these are just some financial tips we thought we could share with you every week. Helps you to become financially savvy. Well, with that, it is a wrap on this edition of Smart Money. Thanks a lot for watching.